Welcome to today's deep dive. In this episode, we'll explore the recent downgrade of the U.S. credit rating by Moody's. This historic move marks the end of America's perfect credit era, and the implications go far beyond Wall Street. We'll discuss the reasons behind the downgrade, the fiscal challenges the U.S. faces, the global ripple effects, and what this means for the future of the U.S. dollar. Let's begin with the big headline. On May 16, 2025, Moody's downgraded the U.S. long-term credit rating from AAA to A1. This follows similar moves from Standard & Poor's in 2011 and Fitch in 2023. Moody's was the last to hold the line, and now it's broken. So what does this really mean? AAA is the gold standard, literally the highest confidence the world can place in a country's ability to repay its debt. Losing it means rising skepticism and a clear signal that America's finances are no longer bulletproof. Moody's cited growing fiscal deficits, a rising debt-to-GDP ratio, and soaring interest costs. It's worth noting that this downgrade happened on the same day former President Trump saw his budget proposal rejected by Congress, adding to the narrative that the U.S. government is struggling to govern itself financially. Now let's dig deeper into why this happened. According to Moody's projections, by 2035, America's federal debt is set to reach 134% of GDP. That's up from 98% in 2024. This level of debt is higher than almost every other advanced economy with a similar rating. Why is debt growing so quickly? First, interest costs. As interest rates rise globally, the U.S. is paying more to service its existing debt. Second, social welfare spending continues to grow, driven by aging populations and health care obligations. Third, tax revenues haven't kept pace with spending, especially with repeated tax cuts and loopholes. Deficits, currently at 6.4% of GDP, are projected to rise to nearly 9% by 2035. That's unsustainable even for a superpower. Let's shift our focus to the global impact. Credit ratings are not just for show. Investors use them to determine risk, and risk determines return. As U.S. credit weakens, investors may demand higher yields on Treasury bonds. That pushes up borrowing costs for the government and for everyone else. Countries that peg their currencies or hold reserves in dollars may reconsider their strategies. More significantly, this could accelerate a global trend already underway: de-dollarization. China and Russia have been pushing for trade outside of the U.S. dollar. More central banks are holding gold, not dollars. The IMF's SDR basket is gaining more visibility. Cryptocurrencies and digital currencies are becoming viable payment and settlement tools. All this puts pressure on the U.S. dollar's dominance, a foundation of America's economic power. Despite the downgrade, Moody's upgraded the U.S. outlook from negative to stable. That may sound contradictory, but it's not. What Moody's is saying is this: we don't think the U.S. will default anytime soon, but if it continues down this path, things will get worse. The U.S. still enjoys three massive advantages. 1. The world's largest and most innovative economy. 2. The dollar's status as the global reserve currency. 3. Deep, liquid financial markets that attract investment, but even these strengths have limits. Without fiscal reforms, even the dollar's dominance can erode. If trust in the U.S. government's ability to manage its finances continues to fade, the consequences could be felt worldwide. So what can we learn from this downgrade? It's a warning not just to the U.S. government, but to the entire world. Over-reliance on debt, unchecked spending, and political gridlock have consequences. The U.S. is still strong, but its credibility is no longer unquestioned. The next decade will determine whether America restores its financial reputation or slips into a new era of uncertainty. Thanks for watching. If you found this breakdown insightful, be sure to like, comment, and subscribe. Let me know your thoughts in the comments below. Will the U.S. respond to this warning or ignore it? Stay informed, and I'll see you in the next video.